Welcome to Thoughts on the Market. I'm Andrew Sheets, head of corporate credit research at Morgan Stanley. Today, I'm going to revisit a theme that was topical in January and has become so again. How much of a problem are higher interest rates? It's Friday, May 30th at 2 p.m. in London. If it wasn't so serious, it might be a little funny. This year, markets fell quickly as the U.S. imposed tariffs, and then markets rose quickly as many of those same tariffs were paused or reversed. So what's next? Many tariffs are technically just paused and so are scheduled to resume. And overall tariff rates, even after recent reductions towards China, are still historically high. The economic data that would really reflect the impact of recent events, well, it simply hasn't been reported yet. In short, there is still significant uncertainty around the near-term path for U.S. growth. But for all of our tariff-weary listeners, let's pretend for a moment that tariffs are now on the back burner. And if that's the case, interest rates are coming back into focus. First, lower tariffs could mean stronger growth and thus higher interest rates, all else equal. But also importantly, current budget proposals in the U.S. Congress significantly increase government borrowing, which could also raise interest rates. If current proposals were to become permanent, for example, they could add an additional $15 trillion to the national debt over the next 30 years, over and above what was expected to happen, per analysis from Yale University. Recall that prior to tariffs dominating the market conversation, it was this issue of interest rates and government borrowing that had the market's attention in January. And then, as today, it's this 30-year perspective that is under the most scrutiny. U.S. 30-year government bond yields briefly touched 5% on January 14th and returned there quite recently. This represents some of the highest yields for long-term U.S. borrowing seen in the last 2 decades. Those higher yields represent higher costs that must ultimately be borne by the U.S. government. But they also represent a yardstick against which all other investments are measured. If you can earn 5% per year long-term in a safe U.S. government bond, how does that impact the return you require to invest in something riskier over that long run, from equities to an office building? I think some numbers here are also quite useful. Investing $10,000 today at 5% would leave you with about $43,000 in 30 years. And so that is the hurdle rate against which all long-term investments are now being measured. Of course, many other factors can impact the performance of those other assets. U.S. stocks, in fairness, have returned well over 5% over a long period of time. But one winner, in our view, will be intermediate and longer-term investment-grade bonds. With high yields on these instruments, we think there will be healthy demand. At the same time, those same high yields, representing higher costs for companies to borrow over the long term, may mean we see less supply. Thank you, as always, for your time. If you find Thoughts on the Market useful, let us know by leaving a review wherever you listen. And tell a friend or colleague about us today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.